Hey guys, Joe Jacobs here. Wanted to come to you today with some thoughts that I've been having about how to try to move some of this inventory that might be in that price range of 1.5 million up to about 2 million. I'm seeing more inventory not only coming to the market but staying longer on the market. Not just in Sonoma County but surrounding counties. So, bottom line, I want to share these two different scenarios. I mean, a lot of people right now think the standard 20% down, 30-year fixed when it comes to a jumbo mortgage. That's totally fine and great, but I think that with rates going up as much as they have over the last 6 months, it is a good idea to at least take a look at some of the other alternatives that are out there. So what I'm going to do is I'm going to take a moment to just compare your standard 30-year fixed rate option to another option that really allows for a 10% down payment, which is utilizing an 80-10-10, and I'll explain that in a moment. And it's a 7/6 ARM, 40-year interest only. So let's go ahead and break this down. What I'm going to do is talk about this 7/6 ARM. And 7/6 ARM means that this rate, whatever the rate may be, would be fixed for 7 years and then adjustable thereafter. Now, it is interest only for the first 10 years, and then it's amortized over 40-year period. So after the 10-year of interest only, you're going to have 30 years to basically pay that down. So it's going to give you a lot of payment flexibility over the lifetime of the loan if this is a loan that one decides to keep long term. So let's kind of break it down. What we're doing is we're looking at a purchase price on both these scenarios of 1.875. What you're doing is you're taking a first loan and you're taking 80% of that purchase price for a max loan of 1.5 million. And then you're doing what it would be called a piggyback second. And that's going to be a variable rate as well that is interest only for 10 years. And that can go for 9.99% of that purchase price. So essentially, you're going to see when you look at this, you're coming in with $180,000, $7,600, right? Versus on your standard 20-year fixed or 20% down, you're coming in with $375,000. So what we're going to do next is just break down the payment. You can see you're obviously coming up with less money, and we're just basing this at 5.25% interest rate on the 7/6 ARM. Rates change on every day on all these products, so this is really meant to give you an idea that can change with your credit score if you decide to put more or less down, but we're going to use this as an example. And then for the 30-year, we're using 4.625 to get our payment. Again, all these can change. But you can see you got your interest only first, your interest only second, your taxes, your insurance, giving you a total payment of $93.79. You compare that to our 30-year fixed of $98.65, you're looking at an improvement in favor of the 7/6 ARM 40-year interest only. Again, obviously this is adjustable, so over time that difference could change, but this is what you're looking at for the first 7 years. So obviously you're looking at a cash flow improvement, but more importantly, we're going to take a look at the cash needed for reserves and what you need to close, because this is really where I think this product becomes useful. So the reserves from the interest-only product, while they're both 18 months, you'll see the payment that is used to calculate the reserves is going to be higher because it's based on a 23-year amortization period. They just want to make sure that the person that is borrowing this money does have truly enough reserves to be able to support the payment down the road. So you'll see that we're using an estimate of closing costs of $15,000 for each of those. Typically, the rate that goes along with this on the 30-year fix may be a point. This scenario, there is no points. Again, this can always change depending on what you decide to do. But what you would need to be verified for each of these, you'd need $429,000 funds to be verified, and then $582 for the 30-year fixed. So that's important because what needs to be verified may be different than what the underwriter is going, or what you're going to come up with at closing. So we will definitely highlight that. $232,000 less on a 1.875 purchase. So, obviously the big value here for a potential borrower as they're looking at inventory on this market is that they can come in on this scenario with about $232,000 less. So, if you're considering buying any inventory that's between 1.5 and 2 million, this is a great alternative if you want to conserve as much cash as possible going into an uncertain market. Real estate has always been a great asset to put your money. It's where you live. Then as well, obviously people have been getting hit by the stock market, pretty hard lately. So they may not have the reserves that they were once used to. So this is a great alternative as well, so that you can conserve some of that upfront cash if you did get hit by the stock market. And then maybe you can park it in some safer investments down the road or after the transaction. The other thing is, if you're going to be selling a replacement, you're selling an old property and buying this one. Maybe you need to wait for that to happen down the road. This is a great short-term option that's going to improve your cash flow and make it so you don't have to come in with as much at closing. So, really wanted to run all this down for you. I know that right now in this market, you should be at least looking at this on a comparative basis. Thought I would share, and hope if you guys have any questions that you reach out.